Hi everyone, welcome along and thanks for checking out this video. I'm going to get straight into it and talk about the one thing that every trader seems to be talking about at the moment, and that is where are equities going to, how far are they going to decline, how big a drop are we going to see, how big an impact is the virus going to have, and what do we need to do and how should we position ourselves. Well, there's lots of ways we can identify where possible bottoms are going to be coming into the markets. There's lots of different contrarian measures we can look at, but there's one I have looked at that is very, very consistent, and it's actually really easy to do. I'm going to be using the VIX futures chart and also the VIX futures CoT data that we have here on our website at MarketsMadeClear.com. So we're going to be going into the VIX futures data. I'm going to go into this in a second, but first of all I want to go over and actually talk a little bit about the VIX chart and show you why this is actually a really good method of doing that. So first of all, I'm going to bring up the VIX chart. So if you're not familiar with the VIX, you don't need to worry about that too much actually. You can just follow the steps that I go through in this video without actually knowing too much about it. But essentially the VIX is a volatility in an index. So what we have, you see random spikes in the market, but these spikes occur whenever the equity market typically declines, because generally we will see volatility increase in equities whenever they actually decline. So you'll know we just had the recent decline through global stock markets, and we've seen the VIX again spike up. But generally, say if you give it an example, you will see equity markets typically go up quite slowly, particularly as the trends become older and older. It gets more and more ponderous and slowly moving, and that's when you'll see the VIX getting edging lower and lower and lower, and volatility really, really low. And then all of a sudden you'll see the VIX spike up just as the index starts to correct, and that's generally how the market will move, with slow move up and fast corrections, and then the market resets, makes a low and starts to move up again slower, and the VIX starts to move down. I just want to illustrate that. I'll put an overlay of the S&P 500 over the top of this chart. So the S&P 500 now is the yellow or the orange candles on here, and you can see if we just zoom into the recent price action, I'll go into the recent price action, you see the current drop that we've currently experienced, and you see the VIX moving up aggressively. But you'll see how it always coincides with the drop in the equities, these spikes here in the VIX as well, with the biggest coming. This drop was in the 2008 financial crisis. We've seen a sustained move down, and it was the biggest move we have here on this VIX chart. So if we can therefore identify where the peak is in the VIX chart, that will tell us that the low and the bottom is in for the equities, and we should be looking then to be on the long side. And as I say, what I'm going to be doing is using the VIX futures CoT data in order to do that. And this is where we're coming back onto the website. If you're not familiar with CoT data, I'm not going to go into all the specifics of it. But essentially what we have here in this window is the commercial positions, the long, the short, and the net. We have the non-commercial down through here. Lots of other numbers on the site, but if you're not familiar with them, not go into them. You can by all means take some time on your own. I want to focus on a really high level, a really simple place to start. And this is by looking at this CoT index, this blue line we have here, essentially, which is derived from the net positions of the commercials. And what we're looking at here is each time the index reaches 0%, that tells us the commercials are selling. Okay, whenever we get into the 0%, they are selling, and they're anticipating a high to form in the VIX and then move lower. And whenever they get short the VIX, that's whenever we get lows in the equity market and they start to move higher. Now, depending on what type of trader you are, whether you're only looking for the major lows, or whether you want to see intermediate lows or more regular lows, you can change the time period we're looking at here. The longer the time period, the 36-month index, you're only going to be picking up rare major lows in the market. If you want to be more intermediate lows, you're looking at an 18-month index, for example. You'll see you get more frequent. And if you want to be picking a lot more of the lows up, even as the smaller cycles, you come down here into the 6-month index, and you'll see we get a lot more of these 0% signals. Now I'm just going to illustrate actually how this is panned out in this historically, using the data we can see here on the chart from 2011. So we've got the last 9-10 years worth of data And I've just went through the chart and I've done some back testing and using this 6-month index every time we've hit 0% here. So not even having to look at the positions and the data, which I would always recommend whenever you're looking at the CoT data. But I just want to keep this really, really simple as a high level starting point. Just looking at whenever we hit the 0% using the 6-month commercial index. I've actually done the testing on this and I'm going to show you on the chart now. Let me just change this over. Get rid of that a second and bring up my S&P chart. I've just used the S&P data, and what I've done here is you'll see little blue boxes on this chart, and that's the point in time whenever the index, the 6-month index, has hit 0%, and that has coincided with a low at every single point through here. If you just use the 18-month or the 36-month, you wouldn't have picked up them all, but you'd have picked up the major ones. So again, depending on the type of trader you want to be, the type of how your view on the market, whether you're a long-term or intermediate or shorter-term trader, will depend on which of the cycles you want to look at. But I just wanted to show how consistent it is by using the commercial index on the VIX data to confirm that we've actually got a peak in the VIX and therefore a low in equities. With that in mind, this week, I'm recording this, it's a Wednesday night. The data is going to be coming out on Friday. I am looking for another surge in VIX futures shorts, the commercial short position, so therefore I'll be looking for another low in the market. As it stands at the moment, obviously, still expecting the market to oscillate around here, but actually drift lower. They could possibly come into around the 2800, maybe even possibly the 2600. We haven't got the confirmation of a potential low yet from VIX data, but that is where I would like to be a buyer in this market. So coming back on to the data, we can see we have had a spike up in this last 2 weeks in the VIX data. If I just zoom in so we can get a better look at this. And the index has dropped down again in the 6 months, so I'd very much expect to see this come down into the 0%. I'd expect that to happen and occur because of a continued increase in the short contracts from the commercials. And if that is to happen and continue this week, as I say, we're 2 days away from the release of the data itself. So if you're watching this video, by all means, come and check the data, check it out, watch this over the next couple of weeks. I'd expect to see the confirmation of the VIX high coming in the next week, 5 to 10 days, and we're looking then to pick up a low from that confirmation. Ideally, as it stands at the moment, possibly coming down into around the 2800 would be a nice area to look then for them and move back to the upside, similar to what we've seen in these previous recent times. Okay, so there's a really, really simple overview to try and identify when a low is actually in the equity markets. And I say I've only just used the S&P 500 here. By all means, you can do your own back testing, whether it's the Dow, NASDAQ, or any other global markets. You'll find a lot of the positions and a lot of the lows will correspond together. But it's a really high level overview to identify when will the low actually be confirmed, and that confirmed low will occur when we get a confirmed high in the VIX CoT data. Okay, hope you find that useful, guys. If you want to follow along, I will be talking about this more and more detail through our live streams every Monday night here on MarketsMadeClear.com. I will, of course, talk on Monday coming about the data we've just had released. And as I say, I'd be expecting to see a further increase in the commercial shorts in here, which will be taking the index down into that 0% and confirming that we have a high in place in VIX. Okay, I'll leave that with you guys. Any questions, by all means, comment on the video below, send in an email, or even join in on our live streams asking questions, and let's see what we can do as the market moves ahead. Okay, thanks for watching, guys.